Silver didn't just rise in January 2026, it ruptured. On January 26, 2026, silver traded above $110 an ounce, a level that many market veterans would have dismissed as impossible not long ago. And it didn't crawl there over quarters. It sprinted. Not months, not weeks. In 48 hours, the tape turned into a blur of vertical surges and sudden air. Pockets. The kind of action that shows up when a market's plumbing is under strain. For years, the comfortable assumption was that silver could be volatile, yes, but it was still contained inside a familiar range of expectations. Then the market printed 110 anyway, and the behavior around that price told a different story. Because when a market moves like that, the public sees a chart. Institutions see constraints. They see who has to buy, who has to sell, and what normal rule changes become necessary when volatility threatens the broader machine. Price is the headline, but stress is the signal, and stress always appears first. By the time anyone says the words extraordinary measures, positioning is already done. Here's where it gets interesting. The silver market began acting less like price discovery and more like boundary testing. Welcome to Signal and Silver, where we decode what matters before it becomes a talking point. If you've ever felt like the real explanation shows up after the move, you're in the right place. Consider subscribing the same way you'd keep listening to that calm elder who always notices the shift in the room before anyone speaks. And as you listen, drop a comment with where you're watching from, because this story is global, even if the price is quoted in dollars. Now let's reconstruct what actually happened and why the silver market started acting like it was being managed, not merely traded. Late January 2026 delivered a sequence worth studying frame by frame. Silver surged into a historic high above $110 on January 26th, after a run that had already become extreme by any normal definition. Around that peak, the market didn't simply reverse, it whiplashed. This wasn't a tidy profit-taking session where price fades and volume dries up. It was the kind of two-way violence that forces participants to make decisions under pressure. When a market is healthy, buyers and sellers negotiate. When a market is stressed, the negotiation turns into a scramble. In a stressed market, you see the telltale signs. Spreads widen. Liquidity disappears at the exact moments it is most needed. Moves accelerate through levels that normally act like speed bumps, and the conversation changes. And start asking, can this settle? Can this clear? That is not a philosophical shift. It's a structural shift, and it's the beginning of the central mystery. On paper, silver is everywhere. It's stored in major vaulting systems. It trades in a deep, globally linked futures ecosystem. It has ETFs, forwards, dealer networks, and decades of history as a heavily traded metal. So why did the action around 110 feel like the market was short of oxygen? Why did each new high feel less like celebration and more like a defensive scramble, as if the system needed the price to calm down? To answer that, you have to step away from the chart and look at the pattern that repeats every time. A metal becomes two things at once: a monetary pressure valve and an industrial input that can't be substituted quickly. In 1979 and 1980, silver became the stage for a famous squeeze dynamic. The details are debated, the personalities are well known, and the narratives are endless, but the skeleton is the same. Concentrated positioning, rapid price escalation, and then a cascade of measures that change the game midstream. Volatility didn't end the episode. Structural responses ended it, because the system could not tolerate the continuation of the move. The lasting lesson wasn't just that prices can overshoot. The lesson was that when overshoot becomes systemic stress, the rules can move faster than the public can adapt. Fast forward to 2011, when silver raced toward $50 an ounce. Again, the story was framed as speculative excess. Again, the reversal was rapid. And again, leverage dynamics mattered as much as sentiment. Whether you view that era as mania or monetary warning, the rhythm is hard to miss. Extreme moves in silver tend to invite structural tightening because silver sits at an awkward intersection. It is small enough to be moved by concentrated flows, yet important enough to matter as a symbol and as an industrial necessity. Now, in 2026, the pattern is resurfacing with a new layer. The market is more global, more automated, and more interconnected with institutional risk management. That means the response to stress can be faster and more uniform, even if nobody ever announces coordination. It doesn't have to be coordination. It can simply be the same incentives triggering the same reactions across the same kinds of institutions at the same time. The language is always neutral. Those phrases sound benign. In practice, they can function like a throttle. If you want to see the battle lines, start with the hard numbers that most people never look at because they seem boring. As of January 27, 2026, open interest in COMEX silver futures stood at 156,637 contracts. That's a specific stack of obligations and exposures, not a vibe. In that same snapshot, commercial traders held 88,144 short contracts against 44,788 long contracts. Non-commercial traders held 475 long contracts against 19,732 short contracts, with another 33,730 in spread positions. Those categories are imperfect labels, but the imbalance matters. When commercials are heavily short, the system relies on the assumption that they can manage that exposure because liquidity will remain, hedges will function, and funding will be available. When non-commercials are heavily long, the system relies on the assumption that they will tolerate volatility without stampeding, and that their leverage can be maintained. But stampedes don't require irrationality. They require margin calls. And this wasn't only a US story, 3 billion renminbi during the year amid that volatility. Whatever your interpretation, the signal is clear. Large, sophisticated actors were not merely watching. They were leaning into the move, taking the other side, and making money from the same turbulence that shook everyone else. Now layer in a separate event that looks unrelated until you understand how flows shape markets. In early January 2026, index rebalancing mechanics created a concentrated wave of selling. $1 billion of silver between January 8 and January 15th. That's not emotion, that's math, that's methodology. And when mechanical selling collides with a market already in a leverage-heavy posture, the price can move in ways that confuse anyone looking only at headlines. Now, let's name the kinds of players that shape an episode like this, because the market is not a single thing. There are bullion banks that make markets in forwards and swaps. There are futures clearing members that intermediate leverage. There are exchanges whose first priority is the integrity of clearing, not the comfort of any one trader. There are large commodity trading advisors whose models buy strength and sell weakness automatically. There are index funds that follow published methodologies, which means they can become forced sellers or forced buyers on a schedule. When silver explodes upward, those groups do not experience the move the same way. A momentum fund experiences it as confirmation and adds exposure until risk limits hit. A dealer experiences it as widening bid-ask spreads and the need to hedge inventory in a market that is moving too fast. An industrial user experiences it as a sudden jump in hedge costs that can compress margins on fixed-price contracts. A clearinghouse experiences it as rising variation margin flows that must be collected flawlessly or the whole chain is at risk. That's why the response to volatility can look like control, even when it's simply survival. Clearing is a chain. If one big link fails, everyone feels it. So the system is designed to reduce the probability of failure by demanding more collateral when prices swing. Collateral is the silent governor on speculative intensity. Raise the collateral requirement and you reduce the number of players who can maintain a large position. Reduce the number of players and you change the shape of the market. Here's an analogy that makes it intuitive. Imagine a highway where the speed limit is never posted, but the toll price changes every mile. When traffic is light, the toll is cheap and everyone speeds. When traffic gets chaotic, the toll price rises sharply. Suddenly, only a few cars can afford to keep racing, and everyone else slows down, not because a police car appeared, but because the cost of going fast became unbearable. That's margin in commodity markets. In a parabolic silver move, that toll can rise quickly. And once it rises, it can trigger forced selling from the very participants who pushed the move in the first place. That's the classic boom-bust rhythm. The trend attracts leverage, leverage amplifies the trend, volatility rises, the system raises the cost of leverage, and the leverage unwinds. The unwind doesn't have to mean the long-term story ends. It simply means the market cannot stay at that velocity for long without something breaking. Soft controls also show up through messaging. When officials and industry bodies emphasize orderly markets and stability, participants translate that into behavior changes. Dealers widen spreads, lenders tighten credit, risk committees cut limits. None of it is a posted cap, yet together it can function like one, right when price becomes politically sensitive for everyone watching closely. So where is the dislocation? It starts with a truth most people miss. Those are three different things. Consider London, one of the key hubs of the global bullion system. $4 billion, equal to about 254 standard silver bars. The headline reads, like abundance. 27,818 tons sounds like a mountain. But markets don't run on mountains. They run on marginal availability. They run on what can move, what can be pledged, and what can actually be delivered when settlement pressure rises. If a meaningful portion of that inventory is tied up in long-term ownership, pledged as collateral, allocated to industrial supply chains, or otherwise not available for delivery into a specific squeeze point, and the effective float can be far smaller than the total, that's how a market can look well supplied in a report and still behave like supply is missing in real time. This is the part no one is discussing enough. Silver is a market where paper claims can multiply far, faster than physical metal can move. Futures contracts, forwards, unallocated accounts, and derivative exposures create layers. In calm periods, those layers provide liquidity. In stress periods, those layers become the source of fragility because everyone suddenly cares about the bottom layer, the actual metal. So when you see a price spike that looks like panic and a snapback that looks like containment, you're often seeing the system trying to reconcile those layers under pressure. It's not always a villain. Sometimes it's simply structure responding to strain. But the effect can resemble control because the market is effectively being forced to slow down. Now, let's talk about the phrase in the title, price controls. Most people hear that and imagine an explicit government edict, a hard cap, a posted price. That's one form. But modern markets can be constrained softly through mechanisms that look like normal procedures, margin changes, position limits, liquidity rules, settlement conventions, reporting requirements, banking capital constraints. None of these have to be announced as controls, yet all can influence how high and how fast a price can run when volatility threatens the clearing system. And when does that become relevant? Historically, it becomes relevant when a commodity's price move starts to transmit stress into other parts of the system. Silver is small relative to many markets, but it punches above its weight because it's symbolic. A sudden surge in a monetary metal can feel like a referendum on currency confidence. At the same time, silver is industrial. A sudden surge can threaten manufacturing margins and procurement schedules. That combination creates incentive for orderly market interventions, whether by exchanges, intermediaries, or policy-adjacent forces that shape financial behavior. To see the mechanism cleanly, imagine a crowded theater with a narrow exit. The exit didn't change. The people changed. In markets, the exit is liquidity and margin. When volatility rises, exchanges and brokers raise the cost of staying in the theater. That cost is margin. If your position is leveraged, a margin hike forces you to add cash or reduce exposure. That forced reduction is selling. In a rising market, forced selling can blunt upside. In a falling market, it can accelerate the decline. Either way, it changes the natural rhythm of price discovery. Now connect that to the data already on the table. With 637 open contracts in COMEX Silver, the market is a network of commitments. Commercials, sitting on 88,244 shorts, are exposed to price rises in one way, even if hedged elsewhere. Non-commercial longs at 43,475 are exposed to margin and volatility in another way. If the price spikes and volatility explodes, the system's first instinct is to reduce leverage. And the fastest way to reduce leverage is to make leverage more expensive. That's how a market can appear to hit an invisible ceiling without anyone publicly declaring one. This doesn't require conspiracy, it requires incentives. If volatility threatens clearing integrity, lenders tighten, risk controls clamp down, and liquidity becomes selective. Tightening risk controls changes behavior. Changed behavior changes price. That is the loop. Let's make the dislocation concrete by contrasting two realities: paper signals and physical realities. Paper silver can be created instantly in the form of new exposures. Physical silver cannot. It must be mined, refined, transported, vaulted, and delivered in acceptable form. When paper demand spikes, paper supply can meet it, at least initially. But if enough participants decide they want physical settlement, physical substitutes, or simply tighter terms, the paper layer is tested. The test shows up as premiums, delivery frictions, and unusual behavior around inventory classifications. Even without listing every category, you can feel it in the market tone. Traders start talking about availability, not just price. They start talking about bars, not just charts. They start talking about who can deliver, not who can predict. That shift is the signal that dislocation is widening. Now add geography. In global metals, flows can split between east and west, between on-exchange and off-exchange, between visible and opaque channels. A headline figure like 27,818 tons in London doesn't tell you whether that silver is poised to move to satisfy demand elsewhere, or whether it is effectively static. And if it's effectively static, then a spike in futures price is not just a reflection of demand, it's a reflection of stress in the promise layer, the layer that assumes metal can be accessed when demanded. This is where historical parallels become useful again. In 1980, the market learned that concentrated demand for physical can collide with paper structures and invite interventions. In 2011, the market learned that leverage can turn a surge into a crash when rules tighten. In 2026, the market is learning a hybrid lesson. Mechanical flows and global positioning can create extreme spikes, and the response can be faster because the system has more automated risk controls. $1 billion of index-linked selling between January 8 and January 15th. That's a rare moment where you can point to a time window and say, regardless of the story, flow is coming. If you see a market surge into late January after such a flow event, it suggests that buying pressure was strong enough to overcome a mechanical headwind, and that's not trivial. It implies either powerful speculative momentum, powerful hedging demand, or a physical-driven scramble that doesn't care about tidy narratives. Now focus on the contradiction at the heart of the episode. If silver is plentiful, why did it move like it wasn't? If the market is liquid, why did it whipsaw like liquidity was fragile? If futures are reliable price discovery, why did the action feel like it was probing a boundary? The simplest answer is that the boundary is leverage and funding capacity. Leverage is the oxygen of modern markets. When oxygen is abundant, prices can run. When oxygen is restricted, prices gasp. And restrictions don't need a press conference. They can be implemented through requirements and limits that, in effect, cap how many participants can hold aggressive exposure at the same time. This is why institutional positioning matters more than hot takes. Commercial positioning, non-commercial enthusiasm, and large overseas short exposures tell you the market was a battlefield of sophisticated actors. The public narrative can be about bubbles and fear. The structural narrative is about who was prepared for the volatility regime shift and who would be forced to adjust when the cost of participation rose. Let me show you what this means going forward, without turning it into a guaranteed outcome. Historically, when silver enters a phase of parabolic movement followed by violent reversal, one of three paths tends to emerge. In the conservative path, volatility cools, leverage reduces, and price grinds in a wide range while the system rebuilds confidence. You'll see it as smaller intraday ranges, stabilizing open interest, and fewer abrupt moves around calendar-driven flow windows. In the moderate path, volatility persists, but the market bifurcates. Paper price trades one narrative while physical channels show persistent tightness through premiums and delivery frictions. In that world, the official price can look calm, while real-world sourcing costs remain elevated and the gap becomes the story. In the aggressive path, dislocation widens enough that structural change occurs. Rules get revised, settlement behavior shifts. Participants migrate to alternative venues. That doesn't require collapse. It can happen quietly, through incremental decisions by institutions that decide certain risks are no longer worth carrying under certain conditions. If you're watching for indicators, focus on what changes under stress. Watch for sudden shifts in margin policy and risk limits. Watch for sharp changes in open interest that don't align with price direction. Watch for unusual inventory movements in major vaulting hubs and for persistent talk of bar availability rather than generic supply. Watch for institutions changing exposure patterns, especially the commercial cohort and large overseas actors. And watch for the tone of official communications around market orderliness, because tone is often the earliest signal of an approaching structural response. Now zoom out to the human layer of the story. There are always two groups in markets like this, not smart versus dumb, not rich versus poor. It's attention versus distraction. One group watches the headline, then watches the chart, then reacts emotionally. They are always late, not because they lack ability, but because the information they consume is designed for after-the-fact interpretation. They learn what happened when it's already priced. The other group watches the plumbing. They watch positioning. They watch flow calendars. They watch institutional constraints. They watch how rules shift under stress. They don't need to be clairvoyant. They just need to see the pattern. And the pattern is that institutions move first, retail moves last, and the narrative is always written to make that feel normal. Silver's January 2026 behavior is a case study in that divide. A market doesn't print above $110 an ounce and then whip back without leaving clues about its internal stress. Those clues sit in commitments, inventories, mechanical flows, and risk controls that tighten right when the move becomes inconvenient. This is Signal in Silver, where we decode what matters before its headlines. If this connected dots you hadn't seen, you know what to do. And remember, the real question isn't whether volatility returns. The question is whether the next time the market hits a boundary, you'll recognize it as a boundary, not a mystery.